Good afternoon, everyone. I hope everyone is doing very well. Welcome back. Today, I thought to start a new lecture series on quantitative finance. I was at university the other day and was chit-chatting with Masters of Finance students, typically those who are involved with the finance studies or want to build their career in the field of quantitative finance. And after chit chat with for half an hour or maybe more than that, I guess. I kind of quite felt that there is a difficulty uh, among students for for many quantitative subjects. So it gave me an idea that okay, why not I should take some initiative to put up some lectures to help students learn about different concepts. Remember, these are we prepare these lectures after reading particular topics from a university textbooks. So we hope, guys, you're gonna enjoy and you're gonna learn something out of it. And please do send your suggestions, comments that help us to improve instructional video contents. So this is going to be first lecture and quantitative finance series. Um, it's a very big area. However, I thought to start with the very simple basic understanding about what are assets, what are markets, why do we need quantitative finance, and what not. Assets are simply bundles of time state contingent claims. So what it means that think about you're gonna receive some claim, or say let's say insurance company is gonna give you claim after 3 or 4 months. So that becomes and along with that you kind of you can bundle up, say let's say dividends you're going to receive, so you can bundle up bunch of claims which you are going to receive, so that becomes your asset. In the same way, that's a very brief way of understanding it, but think about, you own a house, that's an asset. Or you own money in your bank account, that's an asset, that's a liquid asset. You go to the bank and you get the cash out. However, there are assets which may not be liquid, say property, for example, may not be liquid. It can be, if you decide to sell it off. But, so think about assets as bundles of time state contingent claims. Why time and state? Because let's say at present state we are talking and our property has some value, let's say X. After 1 year, that means time, in time, the property value may appreciate. Let's say it went up double, so our asset value increased. So it's sort of that way of understanding. Now, what are financial markets? Think about financial markets as transportation agents. All right, what it means that the markets, think about markets which provide, or which are, who are the facilitator of transporting assets from one state to another state, from one time to another time. Clear? So think about, let's say, vegetable market example, which I usually say in my lecture series. You go to the vegetable market. What the vegetable market is another way. It's an agent, facilitator, which is providing the facility connecting the buyer and the seller, right? So the seller, say onion seller, he or she is transferring the asset onion, right, from one state and in one time to, for example, so you are exchanging the onions with some cash money or dollars. In the same way, financial markets, whether it's a bond market, a stock market, or an exchange market, think about those are transportation agents. Trading assets amounts to transferring assets across time and across states. Let's say, for example, think about you are going from Toronto to Montreal and you buy the train ticket. So what train is doing? It is transporting you from Toronto to Montreal, right? In the same way, a stock market, what it is doing? You are exchanging shares, you are either buying shares or selling shares. Basically, you're kind of transporting your assets from one state, let's say, in the form of shares, to another state in the form of cash. From one time, let's say today, let's say you buy today, that is one time, present time, and you sell after 2 days, that is future time. So trading assets means that. Now there is a little distinct thing here which I put up. I noted it down from a textbook. The speculator in assets is one whose trading aim primarily to expand consumption opportunities in certain states. Right? So what it means that a speculator will gamble on on certain assets, that the value of those assets will rise in time, and then that person will sell it off. So that person or a speculator is not concerned that much what that business is doing. His or her main objective is to buy at current time and sell it off in a hope that the business or the share value will go high. That may go down too, but that's it, business of speculation. Now the hedger term comes in literature. The hedger is one whose trading aim, or whose aim when he or she is exchanging assets or transporting assets from one state and in one time to another state and another time, is to preserve the value of the asset mainly, or make sure that you don't lose the value of your asset, mainly to preserve existing state dependent opportunities, right? Now since we made the concept of transportation agent and assets are bundles of claims, we need some vehicles, right, for transporting things, right? Now the think about the financial market is an agent who is driving this vehicle. Okay, now what vehicles we have? We have mediums through which we can transport things, and who is transporting? The financial market. Say government bonds, the bond market; corporate bonds, bond market; stock market for equity trading; mutual funds, hedge funds, and whatnot, options, right? Those are different instruments we have available, right, or vehicles. Now important question comes, why do we need quantitative finance? All right, so think about an analogy. Let's say the guys who have studied physics, right? So there is a world of Newtonian physics and there is a world of quantum physics, right? So the quantum physics world, we deal with the very tiny dimensions, very small scale, and in Newtonian world we deal at a bigger scale. So for example, in economy, economists, whether government policies, interest rate, GDPs and all, those are like big things, like bigger objects. Similar way, like in Newtonian mechanics, you have planets, you have bigger objects. Newtonian physics fits very well, but when we boil down to at atomic level, it doesn't work in the same way. When we boil down to, let's say, intraday trading, that's sort of equivalent to saying that we are boiled down to a very tiny scale in economy, or in say in our finance area. So we need to deal with the certain techniques which allows us to drive the car smoothly, or in other words, which the mathematical techniques on which we base our or on which we make foundations. We build our models so that we kind of grow our assets at a, at an atomic level in time, and we make sure that we don't lose too much. So the value of the asset we don't lose. So that means that we need some way to quantifying the things. Okay, let's say what is the value of my portfolio today, what will be the value after 1 day, or even at a intraday level, what is the value of the portfolio at 1 hour. Let's say your portfolio is dealing with the foreign exchange trading, so you are more concerned with the every minute activity, right? So you need some sort of quantitative or mathematical way of biasing your decisions on that mathematical foundation. So quantitative finance allows us, gives us a medium or a channel or a tool, mathematical tool, on which we can base our foundations, our decisions, whether to buy, whether to sell, whether to hedge, whether to stay in that position at a micro level. All right. So let's say how much we can learn in this area. It's like we are dealing with the same analogy as I was saying earlier, the atomic level. So we need to understand the statistics, probability, which becomes very important. What is probability? You don't know what's going to happen next moment. So probability is a very good mathematical tool which allows us to do certain kind of analysis before we bet. Okay. So first, an important concept comes here about value at risk. So what does it mean at the value of risk? You guys might have heard, or there are a lot of literature available online, offline, in books, value at risk. So in this lecture, we are trying to formulate mathematically what does it mean. In simple sense, as an investor, you want to know what is the worst case scenario, that I'm going to lose that much money in my portfolio, whatever is your time horizon, 1 day or 1 hour, or say 2 days or a week. So how much value of your value of your assets is on bet, is on risk, right? So let's say you may say that I have 95% confidence that my portfolio will not lose 5%, will not lose more than 5% of its value. So that 5% will becomes your value at risk, because you are confident that rest of your money will be safe. In other words, let's say you have a very simple example. Let's say you have $100 and you say 95% confidence level I have that on any given day I will not lose more than 5%. All right. So what will be the value at risk? Right, you want to know that I will not lose more than 5%. So it will be simply 5, right? Because you are dealing with the 100. Now that was a simple example where you just have one asset, and you gather the past historical data, and you can plot probability density function, or you can plot the box plot, and you can denote that, okay, what are my tail distributions here, and what is my alpha quantile. So let's say this is your quantile alpha level, so this one will become your VAR. But in this lecture, we are trying to understand what is the mathematical foundation or theoretical foundation of value at risk, which later on we can develop computer solutions or algorithms how to get it when our portfolio is complex, multi-asset portfolio. We need a computing solution. We will not be able to get analytical solution. We might have to go on a numerical route to get exact value, right? So let's see. In a simple sense, value of at risk, VAR, is a measure of amount that could be lost, right? VAR calculations typically need portfolio composition, means how much, how many types of, how many companies or how many stocks you have in your portfolio, what is their proportions, time horizon, maybe 1 day, 2 day, or whatever you say your time horizon, and the parameters governing the distribution. Now that's a bit tricky because you don't know, let's say you don't know what's going to happen next day, right? So that becomes things tricky. Let's say tomorrow some news comes and suddenly technology stock starts falling, your all models go wrong. So that's important, parameters governing distribution. And because of there is too much uncertainty, you don't know the price, you don't know what's other factors are, there is a significant level of uncertainty. But based on past performance, you can check certain statistical parameter, and that makes this whole thing complex. We have different risks. We can categorize those risks. Market risk, let's say some bad news comes, your market suddenly goes down, no matter what good company is, it is stock, people start selling and it goes down. Credit risk, for example, you bought banking stocks in your portfolio, and what if bank issued some loans and people are defaulting, Liquidity risk, it might happen that you might not be able to sell when you need, it might be possible that people are not buying these stocks and those stocks you are holding, but you want to sell now, so liquidity crisis. Model risk, simply because we are dealing with uncertainty and we are assuming many things here while when we are developing these mathematical model, so there is a significant risk involved here. So in quantitative finance area, you see, one of the main objective what we are looking for is to minimize the risk at different level. So we have different approaches of modeling, right? And we keep on fine-tuning our models as we get more information built into the model, right? So let's consider a portfolio of n assets with the fixed allocation, and that allocation means that the proportion, it's not the price, it's just the proportion that, okay, A1, A2, A3, that many shares of one company, A2 that many shares of another company, and whatnot. And between time t and t plus h, h is your horizon period, maybe 1 day, maybe 1 week, depends, right? At a date t, means present day, you can assume investor has endowment, which we can represent by WT, okay, and with the price t, that is our price of the time t of, or we can put a number, portfolio average price, and A is the composition, that can be used to purchase this portfolio. So we need this much WTA wealth to purchase this portfolio at time t, present time, and we have an additional amount as well, and we call it reserve, which we do not use to buy the stock. Think about, you have a margin account, okay? So if you use all money from the margin account, what's going to happen if your portfolio value goes down suddenly? Your your broker who is broking stocks for you, he might decide to sell your equities, which you are crossing that marginal limit. So as long as your portfolio value is higher than your limit, you're good. So think about, you're gonna keep some money in margin account. So it's the same way, you have some reserve plus wealth or endowment with which you can buy this portfolio. Okay. Investor chooses amount RT such that the global position, means your reserve plus portfolio value, it corresponds to a loss with predetermined probability alpha. Means that whole thing, it relates to a loss at certain probability level at future date. Let's say your time horizon is 1 day, so next day, right? Now probability alpha measures the risk level, okay, and this condition we can write it in a mathematical equation form, where PT is simply the distribution function of the prices, given that we have information at time t, means present time, which as an investor we used to predict the future prices. Okay, so the probability distribution of our endowment, what's gonna be after 1 day, because our time horizon is 1 day, let's say, and the reserve which we have at current time, which we did not invest, right? So what is the probability that is gonna be less than 0, or in other words, we'll lose everything, right? So that means that this condition we can write it in a mathematical form by equation 1. Okay. Now negative RT, okay, is the alpha quantile of the conditional distribution of future portfolio value, or in other words we call it profit and loss distribution. Okay. Okay. Now the required capital at time t is theoretically equal to value at risk. Okay. So required capital at time t means present time, we need endowment WT plus RT. Theoretically, that is our value at risk, means that we can lose everything, right? That means theoretically that's equivalent to. However, this value at risk is characterized, we can characterize by probability distribution PT and WT plus HA minus WTA. So what we did here, we simply put the value in the equation 1, the value of the VART, this equation, VAR equation A, we put the value in the previous equation number 1. Okay. Or you may think of, we put the endowment value RT. Okay. in the equation number 1, and we get this equation. And we further, if we put what is our total endowment, means A, composition of portfolio, and the price. So we come down to this equation number 2. Okay, or in other words, equation number 2 represents that our value at risk equals to the alpha quantile of probability distribution of change of portfolio value, or our over time. That time is our time horizon, is next day or next week, whatever our time horizon the value of H is, right. So that's the mathematical formulation of value at risk. Negative sign here, it simply says that it's a loss, right? We can lose that thing, but we're going to characterize by the probability distribution function. Okay, so let's say, as I was mentioning earlier, that let's say if we have probability distribution function like this, and we say this is our alpha quantile, then from the alpha quantile towards your mean line, that will be our VaR. Okay, now further note that this portfolio composition A tick means we just taken the transpose of the portfolio composition values multiplied by price at T plus H, means future date, minus PT, price at the current date, the average portfolio price what you have. That can be written as sigma I equal to 1 to n AI Pi T plus H minus PIT. We can further solve this equation. We can write it, let's say if we divide the whole equation by PIT, that is the price of ith stock at time t. So we get this equation. This is another form of writing that we have return multiplied by our portfolio composition multiplied by the price. So A into R. Okay. It means that first thing to note here is that the A star are simply the portfolio allocations measured in dollars, because we multiplied the composition with the price of each stock in our portfolio. Okay, and R is simply the asset return. What it means that value at risk analysis can be done based on either asset return or price change, right? So if you know, let's say, what's going to be the future price or price tomorrow, you can calculate VaR, or if you know the return, you can calculate VaR. Value at risk has two objectives mainly. One is to measure the risk, and second is to determine the capital reserve that can be used for portfolio management, audit, risk hedging, right? So let's say, for example, you decide to open up a margin account with this brokerage company, and you want to know how much value at risk I have each day, so that I can have that much amount of extra money in my account as a reserve, or less, maybe less or maybe more depending upon the margin account policy. But that will make sure that you do not go less than what margin is allowed to you, or you don't go into the margin. Otherwise, the severe implications that your brokerage company may sell your equities as per the your agreement, or you might lose more, or your portfolio is not doing good. So risk analysis becomes very important, especially when you are dealing with day-to-day trading activities, or sort of in hedging too. Let's say you buy stocks today and you want to sell it off after a month. How much money you're going to make it? You're going to keep buying and selling, that sort of thing. So it's used at multiple places. Also, banks need to know. Banks issue debt, mortgages, loans. Bank need to know how much value at risk they have at each day, or quarterly, or yearly. If it is a public traded bank, they need to tell that to their shareholders, and that gives a fairly good idea how much risky that investment in particular bank can be, right? So thank you guys. I hope you have enjoyed this first lecture under quantitative finance lecture series. I'm going to be posting more videos on how to calculate value at risk via different methods, quantitative methods, and so keep tuning into LeProFesseur channel at YouTube. And if you're struggling with the concepts or with this subject, and if you think that I can help you out, do not hesitate to contact me back. And don't forget to subscribe LeProFesseur channel on YouTube. And those who have subscribed, thanks a lot for subscribing. That gives me confidence and boosts me up to create more interesting video lectures. Thank you once again, and have a wonderful day.